Ladies and gentlemen, good day and welcome to Sudeep Pharma Q3 FY2026 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ranjit Cirumalla from IIFL Capital Services. Thank you, and over to you, Mr. Cirumalla.
Thank you, Ranju. Good morning, everyone, and thank you for joining us on Sudeep Pharma Ltd Q3 FY26 earnings conference call. From the company, we have with us today Mr. Sujit Bayani, Managing Director, Mr. Shanil Bayani, Director, and Mr. Ketan Vyas, Chief Financial Officer. We will begin the call with a brief opening remarks from the management, following which we will have a forum open for an interactive Q&A session. I would now like to invite Mr. Sujit Bayani to make the initial remarks. Thank you, and over to you, sir.
Thank you, Ranjit. Good morning, everyone, and a very warm welcome to everyone. I'd like to begin by thanking the IIFL Capital team for hosting this earning call to discuss on Sudeep Pharma's operational and financial performance for Q3 and the 9 months ending for FY26. Before I hand over the call to Shanil, I would like to briefly reflect on our journey so far. Sudeep Pharma, which was founded before 36 years, with a clear vision to innovate in the specialty chemical space, with trust and reliability at the core of everything we do. Over the last 3 decades, we have remained steadfast in delivering on this vision. What began as a manufacturer of mineral excipients, today, we have evolved into a diversified portfolio of over 100 products, serving a wide range of customers over 100 countries. The trust we have built with our customer over the years is strong. Validation of our capabilities, not only to consistently deliver high-quality products, but also to provide customized value-added solutions. The trust underpins our long-standing relationship and reflects on our commitment to excel and partnerships. Going forward, we will continue to remain a solution-driven organization focused on innovation and on developing products that align closely with our customers' needs, while ensuring efficiency and cost effectiveness. Our objective remains to create a sustainable value for all of our stakeholders as we scale the business responsibly. With this, I will now hand over the call to Shanil. Thank you all very much.
Good morning, ladies and gentlemen, and thank you for joining us today to discuss Sudeep Pharma's operating and financial performance for the third quarter and 9 months of financial year 2026. As this is only our second earnings call since our recent listing, I would first like to thank all our investors for the trust and support you have shown us. For those joining us for the first time, and a brief refresher for our long-term partners, I will begin by outlining our journey and the strategic direction that continues to guide our growth. Over the years, Sudeep Pharma has evolved from being a manufacturer of mineral-based pharmaceutical excipients into a technology-driven global supplier of excipients and specialty ingredients. Today, we serve customers across pharmaceutical, food, and nutrition in more than 100 countries, supported by a diversified portfolio of roughly 100 products. This evolution has been strategic. Our focus has steadily shifted towards highly engineered and customized solutions backed by deep expertise in mineral chemistry, process engineering, and strong regulatory capabilities. These strengths allow us to operate in high entry barrier markets, supporting both sustainable growth and healthy margins. From an operating perspective, our business today is organized into 2 primary verticals. The pharmaceutical, food, and nutrition segment contributes approximately 60% of revenue, while specialty ingredients contribute about 40% and continues to emerge as an increasingly important growth driver. With that context, let me now walk you through our performance for the quarter, starting with geographic trends. During Q3, we saw steady and broad-based momentum across regions. This reflects both robust underlying demand and the early benefits of strategic investments we have made over the last few years. Starting with Asia Pacific, the region delivered strong growth during the quarter. This was driven primarily by deeper collaboration with the leading FMCG and infant nutrition customer. Importantly, what we are seeing here is not just one-time growth, but increasing repeat business and wider product adoption, which gives us good visibility into sustainable long-term demand. Turning to Europe, this region is beginning to emerge as a meaningful growth market. Our dedicated sales team is now fully operational, and we have started securing both regulatory and customer approvals. This has translated into strong sequential growth. With multiple products already approved and additional approvals underway, we believe Europe represents a structurally attractive market with a significant medium-term potential. In India, the domestic market continues to provide a stable and reliable base. During the quarter, we delivered growth of nearly 20%, supported by consistent demand and long-standing customer relationships. Looking ahead, we expect export markets, including APAC, Europe, and South America, to contribute an increasing share of incremental growth. At the same time, India and North America will continue to serve as our core markets. Additionally, developments such as tariff reversal and the European Free Trade Agreement are creating a more favorable external environment, further reinforcing our confidence in export-led growth over the medium term. I will now briefly touch upon our product portfolio, which continues to balance stability with expansion opportunities. Our calcium portfolio remains central to the business. It is not only a volume driver, but also a key platform for customer entry and cross-selling. In Europe, our CEP certification for calcium carbonate, where Sudeep is the only company in India and one of just 9 globally, significantly reduces entry barriers and accelerates product approvals. This gives us strong confidence in the scalability of this portfolio, particularly in regulated markets. Beyond calcium, our magnesium and iron portfolios are seeing strong momentum. This is being driven by rising consumer awareness, increasing demand for targeted health benefits, and a shift in supplement preferences. Together, these trends are expanding our application reach, improving portfolio mix, and opening up new customer opportunities. While our core minerals provide resilience, it is the specialty ingredient segment that is increasingly driving incremental value and margin expansion. The specialty ingredient segment continues to strengthen as a key pillar of future growth. During the quarter, our encapsulated and premixed product lines delivered strong growth momentum with improved traction across key customers and applications. More importantly, customer engagement in this segment continues to deepen. In the quarter, we have initiated business with a global leader in tortilla manufacturing, which opens up large volume potential. Here, our encapsulated ingredient helps extend the shelf life and provides the customer an alternate supplier to their current dependence only on an American supplier. In addition, the world's largest baked goods company has expanded sourcing from us to additional geographies, including Brazil and India. This is in addition to USA, where we are now increasing our wallet share. This reflects growing reliance on our formulations. Given the high degree of customization involved, along with switching costs and regulatory requirements, we believe this segment offers secure, scalable, and high quality growth over the coming years. I will now spend a little more time on Sudeep Advanced Materials, or SAM as we refer to it internally, which represents a long-term strategic growth platform for the company and an area where we are increasingly encouraged by the progress we are seeing. At the core of SAM is our battery-grade iron phosphate, which continues to build momentum and is finding wider market need and acceptance across global customers. As supply chains diversify and customers look for reliable, high quality alternatives, demand for an ex-China supply chain has become a need of our customers. In this context, Sudeep is uniquely positioned. We are the first company globally to offer an ex-China source of battery-grade iron phosphate, and this differentiation is resonating strongly with customers across the battery value chain. Increasingly, international customers are viewing Sudeep not just as a supplier, but as a critical and strategic partner in building resilient and compliant supply chains. From a geographic perspective, we have built strong traction across North America, South Korea, Japan, and Indonesia. Engagement levels in these markets continue to deepen, and our focus is firmly on building long-term scalable partnerships. From an execution standpoint, the Dahej battery materials facility is progressing as planned. We broke ground on January 23rd, and phase 1 capacity of 25,000 metric tons per annum remains on track for commissioning in early 2027. Capacity build-out is being closely aligned with qualification progress and demand visibility. We are currently engaged with 34 customers across the battery value chain, and our iron phosphate qualification process is progressing well. Around 70% of these customers have approved and validated Sudeep samples, while the remaining customers are closely working with us to optimize the product for their specific requirement. We have also recently seen commercial scale-up orders from customers who are moving from product analysis to large-scale pilot testing. These orders will be served through the recent upgradation at our existing facilities, where we have added 5,000 tons of battery-grade iron phosphate capacity. The recent quarter also saw multiple facility visits from global OEM, cell, and cathode manufacturers, further strengthening engagement and confidence in our platform. In parallel, we are in active discussions on multiple offtake agreements with large OEMs and cell manufacturers. While details remain confidential due to NDAs, these engagements provide growing confidence in the medium-term demand. These engagements provide growing confidence in the medium-term demand outlook for this platform. Sudeep Advanced Materials gives Sudeep Pharma a differentiated early mover position in a strategically critical battery materials segment with visible customer traction today and potential to scale meaningfully as global supply chains diversify. Our confidence in future growth is underpinned by execution readiness. The Nandesari Greenfield facility, with a capacity of 51,200 metric tons, remains on track for commissioning in Q4 FY26 or more specifically March 26. This facility will enable industrial scale production of higher value molecules such as gluconate, glycinate, and citrates. In addition, the NSS acquisition is integrating smoothly and further strengthens our formulation capabilities and presence in regulated markets. Importantly, these investments are aligned with visible demand and are designed to support scalable growth. In closing, global trends towards health, nutrition, and quality-driven regulation continue to support long-term demand of our products. With deeper customer engagement, expanding global reach, and capacity additions aligned to future opportunities, we are confident in Sudeep Pharma's ability to compound growth in a disciplined and sustainable manner. While we remain focused on execution and mindful of external variables, we believe the depth of our product portfolio, the strength of our customer relationships, and the optionality from new platforms position us well for the next phase of growth. With that, I will now hand over the call to Mr. Ketan Vyas, our CFO, who will take you through the financial performance for the third quarter and 9 months FY26.
Thank you, Shanil. Good morning, everyone. We are pleased to report a very strong financial performance for Q3 and 9 months ended for the financial year 25-26. This performance reflects the strength of our business model, disciplined execution, and favorable market conditions during the period. Let me take you through the quarter performance. Total income for the quarter grew by 52% on year-on-year basis to rupees 179.2 crores in Q3 FY26 as compared to rupees 118 crores in Q3 FY25 on account of better demand and our deeper customer engagement. EBITDA for the quarter stood at rupees 66.8 crores as compared to rupees 41.7 crores in Q3 FY25, representing 60% growth on year-on-year basis. EBITDA margin for the quarter stood at 37.3%. PAT for the quarter stood at 47.7 crores as against 28.7 crores in Q3 FY25, with a strong growth of 66% on year-on-year basis. For Q3 FY26, our export business contributed to 62%, while domestic business contributed 38%. For Q3 FY26, as Shani mentioned, specialty business did very well and is continued to do very well. It contributed to 41%, while pharma, food and nutrition contributed 59%. Let me spend a minute on our year-to-date performance for December end 25. Total income for 9 months FY26 grew by 38% on year-on-year basis to rupees 482.1 crore as compared to rupees 350 crores in 9 months FY25. EBITDA for 9 months FY26 also grew by 33% to rupees 181.5 crores as against rupees 136.7 crores in 9 months FY25. EBITDA margin for 9 months came in at 37.6% as compared to 39.1% in 9 months FY25. PAT came in at rupees 125.7 crores as compared to rupees 94.5 crores in 9 months FY25. For 9 months FY26, our export business contributed to 38%. Our export business contributed to 62%, while domestic business contributed to 38%. For 9 months FY26, specialty business contributed to 43%, while pharma, food and nutrition contributed to 57%. With this, I would like to conclude the presentation and open the floor for the questions. Thank you, gentlemen.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Pratiti with Param Capital. Please go ahead.
Hi. Congratulations on a great set of numbers. I had a question around the financial details that were given. What is the revenue excluding NSS for quarter 3 and 9 months?
Our NSS revenues our revenues excluding NSS were 416 crores on year-to-date basis, and for the quarter they were 156 crores for the quarter. Which, if you look at it, the excluding NSS, our business grew at 35.26% on a year-on-year basis for the quarter, and on a year-on-year basis, excluding NSS, we grew at about 21%.
Okay, all right. And what would be the margins like without NSS? EBITDA margins?
We remain at the similar EBITDA margins as our business trajectory. We remain in the range of 35 to 37% for both on year-to-date basis and for the quarter.
Okay, sure. Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Shreya Chatterjee with Ageless Capital. Please go ahead.
Hello, sir. Thank you for taking my question. Would you be able to give the number of inventory days and receivable days for this quarter? And so when you say that you are one of the competitive suppliers ex-China for the battery chemicals, where is the cost and moat advantage that Sudeep Pharma has versus the Chinese suppliers?
Yeah, good morning, Shreya. Thanks for the question. So I will maybe answer your second part of the question regarding battery materials. So I think how we are positioning Sudeep is an alternative to China to support customers, kind of fulfill the regulatory requirements in critical markets. From a technology perspective, we have developed something what we call green chemistry, which is, I would say, significantly more efficient, both from an environment perspective as well as an OPEX perspective, compared to the chemistry being run in China. So our long-term outlook is that the business will, the focus is not to compete with China on pricing and to have a differentiated pricing model, but operationally the business will be more leaner and more efficient from an OPEX perspective compared to the Chinese chemistry, and also lower on the capex.
And so the number of inventory days as of this quarter, is it possible to share? And how are you seeing the customer volume uptake?
I say we don't publish the balance sheet, but to answer your question, we remain our net working capital days remain in the range of about 180 days, and it supports our growth trajectory in the coming period.
Got it, sir.
Go ahead.
Yes, sir. And I just wanted to ask a bit more about your liposomal chemistry as well. So, apart from the mineral chemistry that you're doing, what sorts of end application uses you're doing for liposomal chemistry? Do we have any regulatory mode over there? If you could share some details, that would be helpful. And any new end products also in that chemistry.
So, Shreya, in the liposomal category, again, the primary focus was initially minerals. Now we are expanding as the platform, the technology and the platform is indigenous and built in-house. We are expanding the capabilities to other nutrients, including, say, vitamins, DHA for brain health, glutathione from a cosmeceutical application. What we are currently focused on is we have taken 2 products through clinical studies, our liposomal iron and vitamin C, and they have shown very strong results compared to the level of absorption in the human body. If you were to take a simple regular iron, the liposomal iron manufactured by Sudeep using our LipoBoost technology has an 80% higher absorption in the human body. So our focus is to kind of build to get scientific data, and then have our technology validated, and then to kind of showcase this to, again, pharmaceutical and food and nutrition companies to position this product for specific end application needs.
Got it, sir. And any plans on when these products will be approved or will be shared with customers? Any timeline to that?
So I think liposomal is currently, I would say, it's in the majority of the projects would be under approval or under stability today. I would say we will start to see a revenue contribution from this maybe in H2 FY27 and more significantly in 28, as we have just completed our clinical studies on these 2 products.
And which would be the geographies from which this revenue contribution will be coming majorly? It would be from North America, Europe, or which geography?
Yeah, it's very diversified. We have, I would say, active engagement across India, North America, Europe, and Middle East. I would say there are targeted product categories which we are positioning for different markets, depending on the end therapeutic area that we are trying to serve in that market.
Yes, got it, sir. Thank you. Thank you for it.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Once again, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Viraj Shah with PGIM. Please go ahead.
Congratulations on good set of numbers. With such strong capacity expansion on cards, could you help me with the capex plans for the next couple of years?
Good morning, Viraj. So I will answer this in 2 parts. So in our core business, which is the pharmaceutical food nutrition, where we have the greenfield getting commissioned next month, we are almost through with the capex, so that 51,000 tons of capacity will come live. Beyond that, we don't have any significant capex planned in the for this business vertical, as we will have enough capacity to kind of grow the business. The specialty ingredients vertical that we have, that's a newer side which we started in 2021. So we are probably at close to 35 to 40% utilization. So no significant capex that will be required there. The only capex that we will be focused on going forward will be towards the battery materials project, wherein we will have phase 1 capex of approximately 300 crores, which includes the land for the entire 100,000 ton facility. It includes the infrastructure for the utility and the infrastructure for up to 50,000 tons, and the actual operational capacity from an equipment standpoint for 25,000 tons.
All right. So, excluding the land, for the remaining phases, can we discount this by close to 50%?
That's correct. So I think without the land and the utility block, because that is an upfront investment that we are making, the scale up from 25 to 100 will be much lower than this. I think a total capex will be approximately 550 to 600 crores.
Okay. Thank you. That's it from my side. Thank you so much.
Thank you. A reminder to all the participants that you must press star and 1 to ask a question. Once again, a reminder to all the participants that you must press star and 1 to ask a question. Next question comes from the line of Dhruv Muchal with HDFC AMC. Please go ahead.
Yeah, sir. Thank you so much. Thanks for the chance. So just one question. I was just trying to imply your 4Q numbers, 4Q FY25 numbers, last year's 4Q numbers. It seems there is some seasonality which happens in the 4Q. I'm not sure if this is just was unique for Q4 last year, or this is typically the nature of business. I'm particularly speaking about the pharma and food nutrition business. So I'm just trying to understand, is there a seasonality which happens in Q4, and probably if it can continue even this year?
Good morning, Dhruv. I would say in general, across the business, there is no significant seasonality that happens. I think, I alluded to this in our call, the previous call that happened as well, that we have a mix of business which is sustainable month on month, and then we have certain annual contracts that we offtake with large customers in the pharma food nutrition space. But the call-offs happen, they basically may operate as a campaign. Historically, what we've seen is Q4 typically is the strongest for the business because we see export contributing significantly. I think the majority of the customers post the new year kind of start planning for the year. And that is where we kind of see Q4 being the strongest. But from a seasonality perspective, nothing major.
Yeah, sure. No, so, for example, if I imply the Q4 number for the pharma segment is about, for last year Q4, is about 112 crores, versus your typical last year's average run rate of about 70 to 80 crores. So it seems some jump which happens in Q4. So I'm just trying to understand, that's a normal jump which happens in Q4.
Yeah, I think so. I think as I said, right, a majority of the export-led growth, kind of starts to realize, or a lot of our new contracts that we are negotiating or have negotiated kind of start to materialize for our Q4, their Q1, and that's how we've seen the business over the years. Yeah.
Got it. Perfect. That's all. Thank you. This is helpful. Thanks.
Thank you.
Thank you. Next question comes from the line of Pratik Chaudhary with Samarthya Capital. Please go ahead.
Sir, I have questions on both your segments. So first one on your core business, with the new capacity coming in Q4 for the base business, how do you, typically when a new expansion is done, how do you see ramp up taking place given customer audits or, facility or product approvals from the new site? And how will you see it for this expansion going forward?
Yeah. So I think it's a great question. I think what happens typically is once we commission the facility, we will have typically a 6 to 12 month period where majority of the customer approvals will happen. As you know, we operate in a highly regulated end market, so customer approval is key. Even though the site may have the necessary site approvals, each customer will go through the approval, and some may even kind of look for stability data. So what we see is that while we will commission the facility in March, H2 is when we kind of expect to start servicing certain customers from that site, and then I would say more significantly in FY28. In Q1 and Q2, we will focus predominantly on getting the site approvals from all our key customers that we plan to serve from the new facility.
And in terms of your per unit revenue profile or margin profile for the kind of products you will make in this facility, is it significantly better than what you're already doing in the existing capacity?
So there's two things, Pradeep, that we're doing here. One is we're increasing capacity of some of our core product, which is carbonates and phosphates. This is being built keeping in mind the guidance that we have with some of our largest customers or top 10 customers in terms of their demand offtake that they want from Sudeep, specifically targeting infant nutrition as a segment. In addition to that, I refer to gluconates and glycinates. Yes, these are new age molecules with very limited global competition and very strong margin profile. They will long term in the next, as they kind of scale, they will help further margin expansion.
And in your earlier call, you had said that this facility would roughly have a 3x kind of an asset turn. So roughly what proportion of that, if say you can do 300, 400 odd crores from this facility, roughly what proportion would come from gluconates and the other product category you mentioned, the high performance, high value ones?
I think I would say at least 50% of the capacity that we've grown here is for the core. So the remaining 50% would come from the newer molecules and newer products that we're launching from this facility.
Okay, great. And on the specialty ingredients, since it's at 40% utilization as of now, which year are you internally planning that the capacity utilization could probably reach optimal utilization levels of 70 to 80%?
Yeah, I think, Pratik, so the next 2 years, I would say, we are key for the specialty ingredient segment. A lot of, I would say, critical customer approvals have come through in this quarter. So we see this segment being I would say, key growth driver for the next 2 years for Sudeep. Both the encapsulated ingredients, I mentioned that we have received certain new approvals. So we work with the largest baked goods company in the world. We are now doing a geographical expansion with them. We are working with the largest tortilla manufacturer now again. So on that front, encapsulated, we have a very strong, I would say, opportunity pipeline. And then from when we talk about premixes, we have just received the approval from probably say one of the leading infant nutrition companies to supply them a blend of vitamin and minerals. So we see the next 2 years, that significant ramp up will take place in the specialty ingredient segment.
Okay, and would it be more than 30-35% that you had clocked in earlier growth?
Yes, so I think that's the range in which the specialty ingredient. As you know, that this business we started in FY22. end of FY22. So 23 is when it started to materially generate any revenue, and since then the growth has been significant, and we believe that the next 2 years that kind of momentum will continue.
Okay. And my final set of questions for the upcoming battery business. You said that the total project cost for 1 lakh tons capacity is around 550 to 600 crores. If you can, maybe just give a rough sense on what would be the asset turns here, probable margins, and then I'll follow up with 1 or 2 more questions.
Again, great question, Pratik. So I think from a capital allocation perspective, we've been very, very mindful. This business will deliver similar asset turns, as our current core business as well.
Which is 3x, right?
Yes, that's approximately 3x. And we have, in terms of how we manage this business from a working capital cycle, so it will also have a strong ROE, ROCE profile as well. And
typical average margin range, EBITDA margins?
I think, Pratik, as we are not operational yet, I will not maybe entirely comment on the margin profile today. It will be, I can maybe generalize and say that
broad range.
But maybe I'll not give a number, but in terms of all the other battery material companies that kind of operate, based on our guidance today and the technology that we've developed, we believe that we can achieve better or higher margins than the broader battery materials industry today.
And final question on your assessment on in what all aspects is your product way more or even slightly more superior than what is available from the Chinese?
In terms of iron phosphate, right?
Yeah.
So I think what we have done is, I don't know if you remember, but this product is not new for us. So we have been making iron phosphate for the past 10 years for a different end application, which is nutrition. We're leveraging that chemistry expertise to kind of just increase the addressable market for the business. Right? What we've done is built on that. We've worked on this product for the past 5 years from an R&D perspective. And today we are seeing, I would say, at par, if not better, electrochemical performance of our iron phosphate vis-a-vis the Chinese vendors that our potential customers are currently using.
And with a greener technology.
Yeah, so I think with the green technology, where for us, the end cause is also important. So it's a lot more sustainable and it's scalable across multiple geographies because we significantly cut down any liquid or solid waste that gets generated using the green technology. And more importantly, it's, I would say, lower in terms of capex cost and operationally or OPEX more efficient.
Okay. Thanks a lot, sir, for an extended answering of my questions, and all the best, and wish you all the luck. Thank you.
Thank you, Pratik.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Once again, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Disha from Sapphire Capital. Please go ahead.
Hello. Am I audible, sir?
Yes, please go ahead.
Yeah, congratulations on a good set of numbers. I'm sorry I joined the call a bit late, so if my questions are repetitive. So firstly, on the US trade deal, the US is a very, very big market for us. And with the trade deal, how do you see the overall market scenario evolving? I think last time we spoke, you mentioned that the customers are on a wait and watch side, but now that we have more clarity, what sort of pickup you see there?
Thanks, Disha. So I would say you're absolutely right. What I mentioned last time was customers who were kind of trying to assess the situation. What I would say further supports or reiterates our confidence in the market is even before the trade deal was announced in Q4, in starting December and more importantly January, we already saw customers starting to call off the volumes that were originally contracted with Sudeep. So that kind of growth momentum and the visibility had already started to materialize. And then with the trade deal, we believe that the project pipeline especially will be much stronger, and more importantly, the wallet share that we're trying to build with the customer will be that much more lucrative also, because Sudeep today becomes, from a tariff perspective, we're awaiting details, but if what we perceive, India will probably be one of the most competitive nations from a pure tariff perspective compared to other Asian countries. So we see both of these materially contributing to North America, and if this were to realize, then in FY27 we'll see I would say North America again significant revenue and growth and margin expansion, all three coming from this market.
All right, that's great to know, sir. What's the contribution for NSS for this quarter?
NSS, I think NSS for this quarter contributes to about 17 odd crores of revenue.
How much, sir? Sorry?
17 odd crores of revenue, and without NSS, our growth has been at 35% on quarterly year-on-year basis.
And how do we see this business in terms of growth, and the margin profile is similar to ours?
So I think one since acquiring the business in May, we focused on making it operationally more competitive through just the raw material supply chain optimization, supplying them products from Sudeep versus them buying from. So the margin profile of the business is now similar to what Sudeep currently maintains. From a growth perspective, we have a very active pipeline. We have just gone through a recruitment cycle. We have appointed a business head for NSS who will be joining this quarter. So I would say over the next 2 years, NSS will meaningfully contribute to the growth of the business, because it operates in the infant nutrition segment. So the approval cycles are longer. It takes at least 12 months to go through the approval cycle.
Okay, all right.
NSS has been growing typically, I would say, 15% historically, and at least for the next year or two, that will continue. And whatever projects that we are able to add through Sudeep, that will be on top.
All right. And so for this Greenfield Pharma project, I think we were planning a total capex of 150 crore. So how much have we spent till now?
I would say largely, Disha, majority has been spent. I believe we have a residual capex of maybe 10-15 odd crores, which will be done in this month and maybe next month. Maybe some spillover in April, but majority has been completed.
Okay, all right. And I think you mentioned that it takes a longer time for approval, so I think we'll see meaningful contribution from H2 onwards. So what sort of utilization are we targeting for next year and for FY28? Because that will have significant contribution from this plant.
Yeah, so you're right. So I think this year I would not say it would be significant from a utilization perspective, because majority of the year will go in approvals. Yes, H1 predominantly, and then it will start to scale up. And then maybe I would say FY28 onwards is when we can look at that scale up of going to maybe 30-40% and then ramping up.
30-40%, right?
Correct.
Right. And so for just the last question on the battery plant, what is the revenue potential that we see at optimum utilization? What's going to be the margin profile and the ramp up? If you could just throw some light on that, that would be really helpful.
So I think I mentioned in my earlier question that we are looking at approximately 550, 600 odd crores of capex. This maintains a similar asset turn profile, around 3x as our current business. We are currently scaling phase 1, which is 25,000 tons. So that will be the ramp up, which will come live early 27. And then there will be a sequential scale up from 25 to 50, and then from 50, depending on how the offtake agreements are kind of developing and the guidance we have from the customer, we may look at scaling 50 directly to 100 instead of doing a step up to 75 first.
Okay. And so with all this greenfield capex coming online, what sort of growth are we targeting for FY27, and what sort of margins are we looking on an overall consolidated basis?
So I would say margin profile, we will again maintain what we have historically maintained in the business. There will not be any significant change in FY27. Battery material anyway will start contributing revenue in FY28. In growth also, I think I think the growth that we've done over the 9 months this year, that kind of growth we will continue to sustain in the coming year as well.
Okay, all right. That is it from my side. Thank you so much.
Thank you.
Thank you. Next question comes from the line of Ankur Kumar with Alpha Capital. Please go ahead.
Hello, sir. Thank you for taking my question. Sir, I've started following your company recently only, so maybe my question could be basic. But if I look at last 2 years, FY23 to 25, our growth was very low in single digits only. But in this 9 months, it has been much better. So can you please comment what exactly has changed in this year?
So, sure. So I think what is basically, we've expanded into key markets, Europe and US. We've built out sales teams in both these regions, which are now helping us scale up faster in these territories. In addition, specialty ingredients was a new business. We commissioned the facility in 22, so 23 was the first operational year, and a lot of approvals have come, so that has been a dominant growth driver. So today, specialty ingredients has become almost 40% of our revenue, which maybe in FY23 was less than 10%.
And sir, in terms of capacity utilization, what will be our capacity utilization right now?
So it's different across different verticals. Specifically, specialty ingredients, we will be close to 40% utilization on the specialty ingredient side. And on our other vertical, pharma food nutrition, currently that specific vertical may be at around 65-70%, but we have the greenfield coming live next month. So that will significantly add to the capacity available for that vertical.
Got it, sir. And sir, in terms of guidance, do you expect this 35-40% growth to continue this year and next year, sir? What are our estimates?
So we are not, but again, we are not giving any specific guidance in terms of revenue growth. What I can say is, I think the growth that we've done over the last couple of years is what we will continue to sustain with a very stable and similar margin profile.
Got it, sir. And sir, on battery chemical, as you said, it will start contributing from FY28.
Correct.
But since it is already started, it will start hitting depreciation and interest will start hitting in our numbers in coming year.
The project Ankur, the project is scheduled for completion in about 18 months. So only when the revenue starts contributing in FY28, then the depreciation will come in. Until that time, it's more of a capital expenditure. As we said, we will look at the debt in the coming period as we go across. Majorly, it is getting financed through our internal accruals. So we don't see a significant interest impact coming in for the project as of now.
Got it, sir. And sir, on this battery side, do we have existing clients who are ready to take us, or we will start looking for sales time after 18 months when the project completes?
So it's a parallel activity, Ankur. As I mentioned, we are already working with 34 customers across North America, Korea, Japan, and Indonesia, and I would say a lot of approvals have gone through, a lot of development cycles have been completed, and offtake agreements are being negotiated or agreed upon as we speak. So by the time we have the capacity available, we will also have an offtake for that capacity.
Sure, sir. Thank you and all the best.
Thank you.
Thank you. Next question comes from the line of Disha with IIFL Capital Services. Please go ahead.
Hi. Thank you so much for taking my question. Just one thing, in the recent weeks, China had announced the elimination of the VAT rebate. How would that be beneficial for products like dicalcium phosphate and other battery chemicals that we are in? If you could just provide some color on that.
Sure, Disha. Thanks. So I think I would say for battery materials, the product we're talking about is iron phosphate. What we have seen in the last couple of weeks is already an increase in price from China for iron phosphate. I think it's gone up maybe 15-20%. And in terms of the re-evaluation of the VAT rebate or the reduction of the VAT rebate will further kind of add to the cost. So that is, while cost is not the criteria for our battery business today, but it definitely supports the overall narrative with the customer. So China is going through, a pricing pressure, and there will be price increase from China.
Right. Another thing on the US tariff, it's positive to see that we are seeing more traction from that side now that there has been a reduction. What I wanted to understand was we had mentioned in the previous quarter that we were sharing the tariff weightage, partly us and partly the customers. When would we have renegotiating our contracts further to provide some relief on that front?
So I think, Disha, again, maybe just to clarify, what we mentioned was 50% of our business was exempt from tariff, and there was 50% which was subject to tariff of our total US business. And in that, the customers were more on a wait and watch mode. They were trying to assess what is the impact of the 50% tariff. We have not taken a margin hit or margin dilution by accepting the tariff impact. Majority, I would say, maybe at least across 90% of the business where tariff was effective, we have passed on the tariff impact to the customer. So from a margin perspective, we've not seen any dilution from the US. This reversal will kind of help, I would say, fast track in terms of wallet share expansion from a volume perspective.
Got it. That's helpful. That's all from mine. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for taking the time to participate in Sudeep Pharma's investor call. Thank you for the participation.
And we look forward to have your participation in the next quarter. Thank you all.
Thank you.
Thank you. On behalf of Sudeep Pharma and IIFL Capital Services, that concludes this conference. Thank you for joining us. You may now disconnect your lines.